the hidden silver shortage nobody is talking about. Right now, somewhere in the global supply chain, a machine worth billions of dollars is running at a loss. On purpose, not because of bad management, not because of a bad economy, but because the entire system that turns raw rock into pure silver is quietly breaking down, and almost no one is watching it happen. The price on your screen says one thing, but the factories, the smelters, the refineries are telling a very different story. One number, buried deep in an industry report, just turned negative for the first time in history. And if that number stays negative, the supply of silver reaching the Western world could start to disappear. Stay with this story until the end. Because what happens next could quietly reshape the value of everything you think you understand about silver. Most people who follow the silver market look at one number, the spot price. It flashes red, it flashes green, and they believe that number tells them everything they need to know. Right now, that number is telling a story of weakness. Silver has fallen sharply from its highs earlier this year. Retail buyers have grown quiet. Many casual investors believe the excitement is over. But that belief rests on a mistake. The price on a screen only shows what traders are doing in that moment. It does not show what is happening underground, inside the mines, and deep within the industrial facilities that turn raw rock into pure metal. And right now, in that hidden part of the supply chain, something unusual is taking place, something that most investors never think to look at. To understand why, it helps to start with a simple question. Where does silver actually come from? Most people imagine a mine built specifically to dig up silver, a place where workers pull the metal directly from the earth. But that image is mostly wrong. According to industry researchers, only about a quarter of the world's silver comes from mines built to produce silver as their main product. The rest, nearly 3/4 of it, is a byproduct. It is found almost by accident, mixed in with ore that companies are really digging up to get copper, zinc, and lead. This single fact changes everything about how silver supply behaves. In a normal market, when demand for a product rises, producers respond by making more of it. If people want more phones, factories build more phones. But silver does not work that way. A zinc mine cannot suddenly decide to dig up more silver just because the price is rising. It digs based on the economics of zinc. If the world needs less zinc, that mine slows down or shuts certain operations, and the silver that would have come out alongside it never reaches the market. The supply of silver is tied to decisions made about entirely different metals. This is why silver has now spent 6 years in a row producing less than the world uses. Analysts who track this closely describe it as a structural deficit. Not a short-term dip, but a repeating pattern where demand consistently outpaces what comes out of the ground. Even the most cautious researchers in this field agree that supply has been getting tighter, not looser, year after year. Now here's where most investors stop paying attention. They assume that once the ore comes out of the ground, the hard part is finished. It is not. Raw ore is not silver. It is a mixture of dirt, rock, and trace metals. Before any of it can become a coin, a bar, or an industrial component, it has to pass through a processing facility. A smelter. This is the stage where miners hand off their material to be refined into something usable. For decades, this step has been treated as a routine, almost invisible part of the supply chain. Miners send their ore. Smelters process it. Everyone gets paid. Few outside the industry ever thought twice about it. But that quiet, routine relationship is now under serious strain. And the strain is not happening because of politics or interest rates or the usual headlines investors are trained to watch. It is happening because the economics of running a smelter have quietly turned upside down. The very businesses responsible for turning raw ore into finished silver are now operating under conditions that would have seemed impossible just a few years ago. This is the part of the story that almost no one is talking about. Not the traders, not the news anchors, not even most silver investors who consider themselves well-informed. The real pressure point in this market is not sitting on a trading screen. It is sitting inside the walls of processing plants that most people will never think about, let alone visit. To understand why this matters so much and why it could shape the future price of silver far more than any single interest rate decision, it is necessary to look closely at what a smelter actually does, and at one specific financial number tied to that process. A number that has just done something it has never done before in modern mining history. That number is where this story turns from a quiet industry detail into a genuine warning. Picture a business that gets paid to provide a service. Now picture that same business, one of the most important in its entire industry, being forced to pay its own customers just to keep the doors open. That is not a hypothetical example. That is the reality unfolding right now inside the global smelting industry, and it is a reality almost no casual investor has ever heard about. To understand how something this strange could happen, it helps to understand what a smelter actually does. Once ore comes out of the ground, whether it is mined for copper, zinc, lead, or silver itself, it arrives as a rough, unrefined mixture. It is not sellable. It is not usable. It has to be sent somewhere to be transformed into pure finished metal. That transformation happens at a smelter. Think of a smelter as the essential middle step between a mine and a finished product. Without it, none of the metal reaching jewelry counters, electronics factories, or investment vaults would exist in usable form. For most of modern mining history, this relationship worked in a simple, predictable way. Miners needed their ore processed. Smelters had the capacity to process it. Because there were always more miners competing for smelter space than there was available capacity, smelters held the advantage. They charged a fee for their service, known in the industry as a treatment charge. Historically, that fee sat somewhere between $100 and $160 per ton. It was a healthy, stable cost of doing business, and it kept smelters profitable. But roughly 2 years ago, that balance began to shift, and it shifted quickly. A wave of new smelting facilities came online, heavily concentrated in one region of the world. Suddenly, there were far more processing plants than there was raw ore to feed them. Instead of miners competing for smelter space, the opposite happened. Smelters began competing for miners. And when too many businesses compete for too little material, prices do not rise, they collapse. The treatment charge that smelters could demand began falling almost every year. What was a stable fee just 2 years ago dropped by roughly half within a single year. Then it kept falling. By this year, the standard industry benchmark reached a level that had never been recorded before, $0 per ton. Smelters were being asked to process ore for free. That, on its own, would already be an alarming shift. But the situation in certain corners of the market became even more extreme. In the segments tied closely to zinc and lead, the very byproducts that carry most of the world's silver, spot processing fees, did not simply fall to zero. They went negative. In some cases, smelters were reportedly paying miners the equivalent of over $100 per ton just to accept their ore. Let that sink in for a moment. These are not small operations. These are massive, multi-billion-dollar industrial complexes, and their primary source of revenue, the fee they charge to do their core job, has essentially disappeared. In some cases, it has turned into a cost rather than a source of income. No business, no matter how large or well-funded, can operate indefinitely while paying its customers to use its services. At some point, the math simply stops working. Facilities begin losing money on every ton processed. Executives are forced to make difficult decisions, reduce output, delay maintenance, or, in the most severe cases, shut down entirely. This is not a distant theoretical risk. It is a financial reality already playing out inside an industry that most silver investors have never spent a single minute thinking about. The mine gets the headlines, the smelter gets ignored. Yet without a healthy, functioning smelting industry, none of the silver sitting in the ground can ever reach a finished, usable form. And this is precisely the moment when a major global energy and resources authority stepped in with a formal warning. Not a casual comment, not a passing mention in a quarterly report. A direct, documented warning about what happens if this negative pricing trend does not reverse. That warning is where the story becomes far more serious and far more relevant to anyone holding or considering holding physical silver. When a major international authority puts a warning in writing, it tends to carry more weight than an opinion shared on social media or a prediction made by a single analyst. That is exactly what happened when a leading global energy and resources body released its outlook on critical minerals. Buried inside that report was a warning that deserves far more attention than it has received. The warning centered on smelters, the very facilities responsible for turning raw ore into usable metal. The report explained something that most people outside the mining industry never consider. Smelters are not simple factories. They are strategic hubs. They are the only point in the entire supply chain capable of unlocking valuable byproducts, including silver from ore that was originally mined for other reasons entirely. Here is where the warning becomes urgent. Because their standard processing fees have collapsed and in many cases turned negative, these smelters no longer earn a reliable profit from their core service. Instead, they have become almost entirely dependent on a secondary source of income, selling the small amounts of precious metal, especially silver, that get separated out during processing. In simple terms, smelters are no longer making money by doing their job. They are making money by selling the silver they find along the way. That silver has effectively become their financial lifeline. Now, consider what happens when the price of silver drops, as it has this year, falling more than half from its earlier highs. That backup source of income begins shrinking at the exact moment these smelters need it most. The one thing keeping many of these facilities solvent is losing value in real time. The report stated plainly that if negative processing fees and shrinking metal margins continue, smelters located outside of one specific region will face serious economic pressure. That pressure could lead to closures. It could lead to bankruptcies. These are not small, replaceable operations. Rebuilding this kind of industrial capacity takes years, sometimes over a decade, and requires enormous amounts of capital. So the question becomes obvious. If smelters outside that region begin shutting down, who ends up controlling the ability to refine the world's silver? The answer is already visible in the data. One country has accounted for the overwhelming majority of new smelting capacity built over the past 2 decades. That same country now controls roughly half of the entire world's midstream processing power, the exact stage where raw ore becomes finished metal. While smelters in other parts of the world are struggling with utilization rates dropping well below normal levels, facilities in that region continue operating near full capacity. This creates a very real strategic risk, one that has nothing to do with how much silver is sitting in the ground, and everything to do with who has the ability to turn that silver into something usable. If Western smelters continue losing money and begin shutting their doors, a large share of the world's silver supply, silver mined as a byproduct in places far from that region, may have no choice but to be shipped there for processing before it can reach global markets at all. This is not a distant possibility. It is already underway, and policymakers have taken notice. Recent public statements from senior government officials have pointed toward the importance of securing domestic and allied access to critical minerals, processing capacity, a clear signal that this issue has moved beyond mining circles and into the realm of national economic strategy. For an everyday investor, this might sound like a distant industrial problem with little connection to a stack of coins or bars sitting in a safe. But it is not distant at all. It goes to the very heart of how much new silver can reach the market, how reliably it can get there, and who controls that pipeline. A shortage in processing capacity can tighten physical supply just as powerfully as a shortage in mining output, and in some ways, it may be even harder to fix quickly. The paper price on a screen cannot reflect this kind of structural risk in real time. It reacts to interest rate expectations, currency movements, and short-term trading decisions. But the physical world does not move at the speed of a trading algorithm. It moves at the speed of factories, contracts, and years-long construction timelines. And that disconnect between the fast-moving paper price and the slow-moving physical reality is exactly where the next part of this story begins. By this point, 3 separate developments have been laid out. Each one on its own would be worth paying attention to. Together, they form a pattern that becomes far harder to dismiss. The first is the ongoing supply deficit. For 6 consecutive years, the world has used more silver than has come out of the ground. This year alone, that gap has widened to more than 46 million ounces. This is not a single bad year caused by one temporary disruption. It is a repeating, multi-year pattern, one that is held steady even when researchers apply their most conservative estimates. A gap this persistent does not resolve itself overnight, and it does not care what the spot price happens to be doing on any given afternoon. The second is demand, and specifically industrial demand, which has quietly become the dominant force in this market. Roughly 60% of all silver produced now goes toward industrial and technological use. Solar panel manufacturing has been a major driver. So has the rise of electric vehicles, particularly newer battery technologies that rely on silver components. Even in the areas where demand growth has started to slow, other sectors are stepping in to fill that space. Data centers, artificial intelligence infrastructure, and next-generation battery systems all require silver, and none of them are going away. The third force is the one explored in the previous part of this story. The midstream processing system, the smelters that convert raw ore into finished silver, is under real financial strain. Negative treatment charges have turned a once stable business model upside down, and an international authority has already warned that continued pressure could force closures outside of one specific region, tightening the pipeline even further. Individually, any one of these 3 forces would matter. Together, they describe a market where supply is constrained, demand is rising, and the physical infrastructure needed to convert raw material into finished product is under genuine stress. And yet, none of this is reflected in the number flashing on a trading screen. The paper price of silver right now is responding to a different set of pressures entirely. Interest rate expectations, currency strength, short-term positioning by traders, reacting to economic data releases. These forces move quickly, sometimes within minutes, and they are largely disconnected from what is physically happening inside mines, smelters, and industrial supply chains. This is the core disconnect at the heart of the current moment. A trader watching a chart sees weakness. A supply chain analyst watching the physical market sees tightening. Both are looking at the same metal, yet they are seeing 2 very different stories. It is worth noting that this disconnect has not gone unnoticed by major financial institutions. Several large banks and research firms have maintained notably elevated long-term price targets for silver, even as the short-term price has pulled back sharply. Their reasoning tends to center on the same structural forces described here: a persistent supply deficit, record industrial consumption, and a processing bottleneck that cannot be resolved through short-term price movements alone. Paper contracts can be traded in seconds. A solar panel cannot be manufactured in seconds. A battery cannot be assembled in seconds. And a smelter that has shut its doors due to unsustainable economics cannot be reopened in seconds either. There is a physical reality underneath this market that moves at its own pace, regardless of what happens on a trading screen from one day to the next. This raises the central question that this entire story has been building toward. What happens when a paper price and a physical shortage can no longer be reconciled? What happens when the gap between what a screen shows and what a supply chain can actually deliver becomes too wide to ignore?